Welcome to the Hurst Trading Room. My name is David Hickson and today is the 2nd of May 2016. In today's webinar we're going to be taking a look at moving from analysis into trading. But before we get started we need to, as always, please make sure that you have read and understood these disclaimers. They are legally obliged and they are also very important, so please make sure that you understand them and have read them carefully. In our previous webinar 2 weeks ago, I took a deep dive into a consideration of the analysis in the S&P 500 at the moment, and that new sort of focused approach into the analysis was very popular. And so I'm going to keep that focus, and I'm going to speak this week about making trading decisions on the basis of your Hurst cycles analysis. You know, I spend so much time speaking about analysis and thinking about analysis and talking about what's happening in the markets that sometimes I forget that really the whole purpose of all of this is, of course, to make sensible trading decisions, because that's what we all want to do. The reason why we analyze the markets, apart from the fact that it provides us with some intellectual satisfaction and stimulation, is, of course, to be able to make correct and sensible trading decisions that result in profitable trades. And so that's the focus of today's webinar. There are many different approaches to trading any market on the basis of a Hurst cycles analysis, and I'm going to really be focusing on two trading methodologies. Hurst's original trading methodology, which was the methodology that he presented in his Hurst Cycles course in the 1970s. And I'm also going to speak about the FLD trading strategy, which is a trading strategy that I've worked with for years, and it's based entirely on Hurst's trading methodology, so it's not a huge leap in a different direction. But you should be aware that there are many different ways of approaching making trading decisions on the basis of your Hurst cycles analysis. And today we're going to touch on two of them, but there are many others. So I don't mean to suggest that there is only one or two ways of trading on the basis of your Hurst cycles analysis. There are many, many ways. I just want to adjust the screen a little bit so that we can see those dates. There we go. I think at the foot of the chart it would be useful to make sure we can see those dates properly. Okay, so the first thing you need to do when you're going to start making trading decisions is, of course, you have to make sure that you understand the analysis that's being presented to you on your chart. And so to that purpose, I'm going to quickly do a quick refresh of the discussion that we had in our previous webinar about the analysis and what this analysis means. So here is the S&P 500, and I believe this is the cash index, and I discussed at length last week the analysis and what I believed was happening. I'm not going to go through all of it again because it took about an hour to do that, so obviously I'm not going to repeat all of that, but I would like to point out a few of the salient points so that we're all on the same page in terms of then approaching making trading decisions. The first thing I'd like to point out, and perhaps the first really important point I'd like to make in this webinar, is the concept of analysis certainty and, of course, analysis uncertainty. Many of us spend a lot of time analyzing markets and thinking about them and wanting to get to the point where we are absolutely 100% confident in our analysis. We have complete analysis certainty. I would like to suggest that, in fact, the concept of analysis certainty is a bit of a myth. I don't think that it is ever possible to be 100% confident in your analysis. And therefore, I think the sort of constant pursuit of analysis certainty can be a bit of a mistake. Quite a lot of time can be spent trying to refine the analysis and trying to make sure whether whether you are really right about the magnitude of those troughs. Instead, I think it's useful to take an approach whereby you recognize that analysis certainty is probably something that you're not really going to be able to achieve, and instead you work with a degree of analysis uncertainty. And so I think when considering an analysis and being about to make trading decisions, I think it's important to work out what you are confident about and what you are not confident about. So in other words, where is your analysis certainty and where is your analysis uncertainty? Now, here I'm showing the S&P 500 since the beginning of this year, or since about the middle of January. And here you can see this trough in the middle of February. That's the 11th of February. And as discussed in our previous webinar, I believe that that is a trough of 18-month magnitude, of at least 18-month magnitude. And that's something that you're going to hear me saying all the time. I believe this is a trough of at least 18-month magnitude, or at least a particular magnitude. The reason I say that is because every trough and every peak that forms in the market brings with it a level of confidence. My confidence in that trough is that it is a trough of at least 18-month magnitude. Before that trough formed, I was expecting a trough to form of at least 20-week magnitude. So I knew we were looking at a trough that would be of 20-week strength. As it happens, it turned out to be of at least 18-month magnitude. On this particular chart, you can see that, of course, the magnitude of the trough is 54 months. Now, I think that's a little bit questionable. It's on the chart. It doesn't really worry me. In terms of making trading decisions, I focus on the fact that that is a trough of at least 18-month magnitude. It might be longer. It might be 54 months. It might even be 9 years. And in last week's webinar, not last week, our previous webinar, I showed you charts with all the different options, 18 months, 54 months, and 9 years. So we considered those different possibilities. In terms of analysis uncertainty, that trough has some uncertainty. Yes, it might be 54 months, it might be 9 years. But the important thing is that that is a trough of 18 months. And so, in my opinion, that's what's important here. I also discussed in our previous webinar the formation of the 80-day cycle trough. And you can see here the 80-day cycle trough has been pinned. You can see that little pin symbol, I think, next to the diamond markers for the trough. It's been pinned. In other words, I've influenced the software. I've told the software, or I've asked the software to please position that particular trough in that position. And we discussed in our previous webinar reasons for doing that. In particular, a very important reason, which is really worth reminding ourselves about, is that if I measure the number of days between the February trough and the middle of April or 12th of April trough, that is 61 days. Now, the average length of an 80-day cycle is 68 days. So, in other words, that is a cycle which is about 10% shorter than the average length of that cycle. It is also possible that that 80-day cycle trough has not yet formed and that the market is now heading down into that trough. So let's quickly go and have a look at a chart that presents that option. And here is such a chart. I have persuaded Sentient Trader to do that by, as you can see, pinning the 40-day cycle trough over there towards the end of March. By pinning the 40-day cycle trough over there, I've managed to get Sentient Trader to realize that it cannot confidently place the 80-day cycle trough, and therefore we're left with this nest of lows, indicating the period of time in which the 80-day cycle trough is expected. So now, as somebody pointed out in our previous webinar, it is possible that the market is still coming down into an 80-day cycle trough, after which it's going to bounce out of that 80-day cycle trough. Now, there are many reasons why I believe that the 80-day cycle trough on the 12th of April is more likely to be the correct analysis. And I'll summarize them very quickly because it is quite an important point. The first is, of course, the number of days. If we count the number of days from the 18-month cycle trough in the second week of February, you will see that the placing of the trough on the 12th of April gives us 61 days. That's 10% short. If that cycle is still coming in to form a trough now, so in other words, we're seeing a drop down into the 80-day cycle trough, then in fact, if I skip the weekend, that means that cycle has been at least 81 days. If it happened on Friday, then that would be 78 days. That is 10 to 14 days longer than the average length of an 80-day cycle. Now, when do we expect cycles to be shorter? When do we expect them to be longer? Well, following the formation of a really prominent trough, such as this 18-month cycle trough, and here you can see it's marked as an 18-month cycle trough. Following the formation of a long cycle trough, all those longer cycles, in other words, the 18-month, the 40-week, the 20-week, those cycles are all pushing upwards, which gives the 80-day cycle an underlying trend, the combined influence of all the longer cycles. It gives the 80-day cycle a bullish underlying trend because those longer cycles are pushing upwards. When you have a bullish underlying trend, you expect troughs to occur early as opposed to late. Now, this is not a science, something that I mention really often. Performing an analysis and even making trading decisions is more of an art than it is a science. That's something that Hurst himself said. He said that a cycle, a phasing analysis, was more of an art than a science. And so we have a bullish underlying trend for the 80-day cycle, and we therefore expect the trough to occur early as opposed to occurring late. It's an expectation. It's not an absolute guarantee. So I have been speaking about analysis certainty and analysis uncertainty. This position of the 80-day cycle trough is certainly an aspect that we are a little bit uncertain about. And therefore, it's something that we need to bear in mind as we approach making trading decisions. I'd like to point out another reason why I think it is very likely that the 80-day cycle trough lies behind us and happened in the middle of April. If you have a look at this circle over here on this analysis, that circle represents the actual day that the 80-day cycle trough was expected, assuming that it keeps beating with the recent wavelength that it has been expressing. If we draw a vertical line up there, and I'll try and keep this line as vertical as possible, you look up here and you see a trough. When that happens, it is often an indication that in fact that is the trough that was expected on that particular day, or certainly if it happens very close to that time. That gives me increased confidence in the concept that the 80-day cycle trough does lie behind us. But when we're going to approach making trading decisions, we have to keep an open mind to both possibilities. And that's what I mean about making trading decisions, even on the basis of some analysis uncertainty. My analysis uncertainty has to do with the position of this 80-day cycle trough. It is possible that it is just forming now, but it is more likely that it lies behind us. So let's move forward and start considering how we're going to trade this market. The next thing that I always do is I ask myself, what is the dominant cycle? Now, we spoke in our previous webinar about the dominant cycle. What is the dominant cycle? Well, there's quite a lot of confusion around what the definition is of a dominant cycle, and I thought I would try and take the opportunity to clarify that a little bit. In Hurst's Cycles course, in Chapter 1, or Lesson 1, Hurst speaks about the dominant cycle. In fact, it's just something that he slips into the glossary, and he speaks about a dominating cycle. And his definition of dominating or dominant wave is that it refers to that price wave which is most visually evident in a composite wave or in price action. That's word for word from Hurst Cycles course. Most visually evident. What does that mean? Well, most visually evident literally means that it's the easiest cycle to see. And that's what I always work with when I'm speaking about dominant cycles. In Lesson 3, as a matter of interest, Hurst then introduced the concept of a dominancy envelope, and he in his glossary stopped mentioning the dominating or dominant wave concept, and instead started speaking about the dominant wave or dominant component as the longest wave contained in the dominancy envelope. So it was almost as though his definition shifted slightly, because there was new information about dominancy and what a dominant cycle is. And he has a rather long, complicated a definition of a dominancy envelope, which is worth mentioning here. He says a dominancy envelope is a computer-generated aid present on Cyclitech charts. Okay, so we have an immediate problem, because Cyclitech charts were printed and available in the 1970s, 40 years ago, and there aren't any Cyclitech charts anymore. So the entire definition of sort of dominancy becomes a little bit complicated, and a little bit confusing. So I'm going to explain how I regard dominancy, how I think about it, and how it becomes a really important thing for me in terms of making trading decisions. Now, I'd like to point out, I'm looking here at a daily chart. Each one of these bars is, of course, one day, and I'm speaking about years. If you are trading on a much shorter time scale, then obviously you'll be looking at much shorter time frame charts. And most of the concepts and principles I'll be speaking about today can be conveyed into shorter and shorter time frame charts. Not entirely, however. And so if there's time, I'll spend a little bit of time towards the end of today's webinar speaking about some of the things to consider when you're looking at trading intraday, because cycles don't relate exactly, they don't translate exactly from end of day to intraday. There are a few little points to consider, but the general concepts and the general principles do hold. Okay, so if we have a look at this chart, Hurst mentioned that the dominant cycle, if you like, is the most visually evident, which to me means that when you look at it, you can see it really clearly. And so there's a cycle that I can see really clearly. It's visually evident. Here's another cycle that I can see really clearly. And by a cycle, I mean a move up and then a move down. That's quite important, because what's happened since 2009? We've had the move up. Have we had the move down? No, we haven't. So can we say what the dominant cycle has been since 2009? The truth is we can't, because we haven't seen the downward leg yet. And you can only say with complete conviction what the dominant cycle is after you've seen the downward leg, by which time, of course, it's too late to trade it, because it's happened. Okay, you've seen the move up and you've seen the move down. But I can say with some confidence that there was a dominant cycle of, 2002 to 2009. There's a dominant cycle of, if you measure it exactly, it's about 6 years, I think. And if you measure the previous one, that was also about a 6-year cycle. So there was a dominant cycle, it would seem, a visually evident cycle that was of about 6 years in length. I see David has lost the audio. Is that is that something that's happened to everybody? Have you all lost the audio? Please, if you can hear me, let me know. And if the audio has gone, then I will have to have a look and see what the problem is. Robert says it's still good. Good. Okay, so I'm afraid David, perhaps somebody can type a message to David suggesting that they check the, check the speaker cable or something, but say it in a nice way. Your headphone cables. Anyway, I'm glad I'm still broadcasting. I'm gonna keep going. Thank you very much for letting me know, everybody. So let's get back to the concept of dominancy and the dominant cycle. We had a dominant cycle, about a 6-year cycle. What's been happening since 2009? Well, we've seen a move up, but we haven't yet seen the move down. That move up has taken so far about 6 years. We haven't yet seen the move down. So it looks as if though we are in a dominant cycle of at least 9 years. Now, there I am saying it again, those words at least 9 years. It's possible that our dominant cycle could even be an 18-year cycle or a much longer cycle. That's an important concept. But I hope you can see by looking at the chart how a dominant cycle results in, very simply, what is a visually evident cycle. Now, many people speak about there being one dominant cycle, and they say things such as, I think at the moment the dominant cycle is the 20-week cycle or the 80-day cycle. That's the dominant cycle. I believe, on the other hand, that it is possible to have many dominant cycles. And so let me just zoom in on a bit of this chart and show you what I mean by that. Here is a period of time. Oh, I'm sorry about that. That's an alert from my MT4 platform. I hope to show you something in the MT4 platform later, so that's why that's running. Here is a cycle that clearly moves up and then moves down again, and it moves down pretty much almost as far as it moved up, and so that is clearly a dominant cycle. What cycle was it? It was the 18-month cycle. Here we had a cycle that moved up, it moved down a little bit. Would you call that a dominant cycle? I wouldn't really, because remember, a dominant cycle needs to push the market up, but then also, very importantly, push it down again to fulfill its role as a dominant cycle. And we can keep zooming in here. In fact, let me just zoom in on a slightly different section. Yeah, here we go. You can keep zooming in, and you can see lots of evidence of cycles that are pushing the market up and then pushing them down by pretty much an equal amount. That there is a 20-week cycle. All right. So during that period of time, what was that, early 2011, we were potentially in the group of a 9-year dominant cycle, but we also had a 20-week dominant cycle. Okay. So the really important thing there is that there can be multiple dominant cycles that are influencing the market. I believe it's important not to get too hung up on the concept of dominance, but it is very important to recognize what cycle is dominant in terms of the time frame that you want to make trading decisions. I see some more people joining us. That's great. Thank you. Hello to everybody. Here is the sort of third important concept in today's webinar, the concept of a time frame, the time frame that you're going to be trading over. When I started trading, I had a career as a film and television director, and I spent most of my time doing that and some of my time trading, and my time frame was a few months. I would want to get into a trade and hold that stock or whatever it was that I'd bought. I would want to hold it for a few months. That was my time frame. Gradually, as I became more interested in trading, my time frame shortened. I spent several years trading the 40-day cycle. It's a cycle I really came to enjoy trading very much. And so for the purpose of today's webinar, I'm going to focus on a 40-day cycle. So what kind of a time frame is that? Well, a 40-day cycle is an average length of 34 days. So if you look at this very simply, the cycle is expected to move the market up for 34 days and then down for up for half the time and down for half the time. In total, you have a 34-day cycle. So you're looking at a long trade, which would be about 2.5 weeks, and then a short trade of about 2.5 weeks. That's the basic idea. So the time frame that I'm speaking about in terms of making trading decisions in this webinar is I'm looking at entering a trade for a couple of weeks. I want to get into a trade for 2 or 3 weeks and then get out of that trade. So that for me means that I need to be trading the 40-day cycle. So that's an important decision to make. The next thing to ask yourself is, what is the dominant cycle that is affecting your trading time frame? So I'm trading the 40-day cycle. What is the dominant cycle that's affecting my trading time frame? Is the fact that we are possibly in a 9-year dominant cycle, is that affecting my time frame? No, it isn't really, because it doesn't really bother me what happens on the 9-year time frame scale. But as discussed in our previous webinar, it is likely that the current dominant cycle is of either 20-week magnitude or 40-week magnitude, and those kinds of dominant cycles are definitely going to affect my trading decisions when trading using the 40-day cycle. Of course, if you want to be trading for a period of a few hours, then you're not going to be looking at the 40-day cycle. You're going to be looking at trading the 1-day cycle, maybe, or the 2-day cycle, perhaps the 5-day cycle, or perhaps the 5-hour cycle. Okay, so these principles can apply at shorter and shorter time frames with a few differences. So now, why do I say that there is a dominant cycle of either 20 weeks or 40 weeks? Well, if you have a look at this price move up here from the middle of February, you can see the move up, but we have not yet seen the move down. Now, it doesn't have to be a perfectly balanced move up and move down in order to be a dominant cycle, but it has to be pretty close for that cycle to qualify as a dominating cycle. So we know that if the 80-day cycle trough is behind us, and as I've pointed out, there is pretty good evidence that the 80-day cycle trough has already come in. If that is the case, then certainly the 80-day cycle has not been dominant, or is not dominant at the moment, which means that the shortest cycle that could be dominant is certainly the 20-week cycle. That would mean that we would expect price to rise up as it has done, form a little move down for the 80-day cycle, bounce up again, and then come down again into the 20-week cycle trough. That's what it means if we have a dominant 20-week cycle. Okay. And I see Alan mentioning the 5-day cycle. The amplitude of the 5-day cycle is 2 times the amplitude of the 1-day cycle on average. Right. So the 5-day cycle is a very interesting cycle to trade, and that involves a whole discussion about intraday, but very interesting. So if we have a 20-week cycle which is dominant, then I have drawn the M shape that we expect. So the first thing you do when you're going to make trading decisions is, having chosen your time frame, is you look at the dominant cycles and you say, what would we expect according to the dominant cycles that might be active in the market? Well, now, if the 20-week cycle is active in the market, then we would expect that 20-week cycle to give us a good clean cycle shape. Move up, move down. So that means that what we are trading now is definitely the move down into the 20-week cycle trough. Okay, that's a really important thing. So what's the first sort of thing we've decided as we're approaching a trading decision? I want to be trading over the next 2 or 3 weeks. That's my time period. And the next 2 or 3 weeks on this chart is shown by this sort of time period over here. That's going to be the duration of time of my trade. If the 20-week cycle is dominant, then I am going to be looking for a short trade, because, of course, the 20-week cycle will have carried the market up and it will be carrying it down. So I want to be in there for that downwards move. It's very important. And I see David is still not hearing any audio. He can hear Tasty Trade, but not us. I wonder whether he has some issue. Perhaps he should log out and log in again. Might be the best solution. But I'm pretty confident everybody else is hearing me. Yes, thank you, Luis. Okay. So in terms of approaching our trading decision, we're looking at entering into a short trade. Okay, that's quite an important thing. If the 20-week cycle is dominant, but there is another bit of analysis uncertainty here. What if the 40-week cycle is dominant? How is that possible, you might ask? Well, let's just zoom back a little bit and look at the most recent dominant cycle. Here you can see it. A move up, followed by a move down. Okay, nice clean cycle shape, and that took place over a 40-week cycle. Okay, so recently the 40-week cycle has been dominant. Does that mean it's going to keep being dominant? No, because remember, cycles constantly are changing in amplitude and wavelength. It's a very dynamic situation, the ways in which cycles influence price movements in the markets. And so the dominant cycle is not going to remain the dominant cycle forever, but there is a good possibility that the 40-week cycle is still dominant. If the 40-week cycle is still dominant, what does that mean for our trading? Well, let me pull that price down and slide it over a little bit and show you what a 40-week dominant cycle would mean. It would mean that price is going up. It's going to form a peak over here and then come down into the 40-week cycle trough over there. So again, we have to ask ourselves, what are we looking at over the next few weeks? Because that's the trading decision that we are making. Can you see what we're looking at over the next few weeks? We're looking at a bit of an upward movement. Now we have analysis uncertainty. Not only do we not know where that 80-day cycle trough formed, but we're also not sure what the dominant cycle is. If it's the 20-week cycle, then we're looking at entering into a short trade. If it's the 40-week cycle, then we should actually be looking at entering into a long trade. Wow, so how do we deal with that? Okay, time to really start speaking about trading. Let's first of all speak about Hurst's trading methodology. Hurst's trading methodology works like this. He recommends that you choose a trading cycle. And we've chosen a trading cycle. I've chosen the 40-day cycle. That's my cycle. That's the cycle that I want to trade. You then ask yourself, what is happening next for the 40-day cycle? So let's just zoom in and have a look at this 40-day cycle. Here is the most recent 40-day cycle trough, which formed, according to this analysis, of course, on the 12th of April. And we expect to see an M-shaped cycle coming down to the next 40-day cycle trough. The next 40-day cycle trough is expected over here towards the end of this week, or perhaps early next week. Now that's because recently the 40-day cycle has been running short at 24 days. In fact, the average length of the 40-day cycle is 34 days. So let's just clear this and let's just work out where 34 days is. 34 days would be over here, call it the 16th of May. Okay, so that's really where we would expect an average 40-day cycle to form a trough. Further, what are we expecting? Well, we're expecting an M-shaped cycle with a move up, a move down to the 20-day cycle trough. Here's the nest of lows for the 20-day cycle trough. Then a bounce up to another peak, and then a move down into the 40-day cycle trough. Okay, so we ask ourselves, what is happening next for the 40-day cycle? What's happening next is that the 40-day cycle is going to move down and form a trough. Okay, that's the really important thing. Now, there are two possible trades that we could make here. On the one hand, we could enter into a short trade to catch the move down into the 40-day cycle trough. Or on the other hand, we could wait until the 40-day cycle trough forms and make a long trade as price bounces out of that trough. Okay? Those are the two possible trades that we could make. So let's just step back a little bit again and remind ourselves of the more general situation. If we have a 20-week cycle which is dominant, then we would be interested in entering into a short trade. So we would be looking at the market bouncing out of a 20-day cycle trough and then coming down into this 20-week cycle trough. Of course, on the way down, it will bounce out of the 40-day cycle trough. And so we won't get a straight line move. We'll get a move that's something like that. And so over the next few weeks, we might be interested in catching that short trade. That's if the 20-week cycle is dominant. But what if the 40-week cycle is dominant? Well, then we actually want to wait until the 40-day cycle forms a trough and enter into a long trade. Okay, so this is where our analysis uncertainty becomes important. We need to make some clear trading decisions here. The first thing that's really important, I believe, to understand is that just because you're ready to make a trade doesn't mean that there is a good trade ready to be made. We're ready to trade the 40-day cycle. Does that mean that today I should be jumping into a trade? No, not necessarily. One of the great things about working with Hurst cycles is it gives you an idea of when to expect things to happen. So when would we expect to get into a good short trade? Well, if we have a look at this sort of scribble that I've drawn on my chart, and let me draw it a little more carefully. If the 20-week cycle is dominant, we're going to expect the market to bounce out of a 20-day cycle trough, come down into the 40-day, bounce up again, and then come down into the 20-week, if the 20-week cycle is dominant. What's the best trade there? Looking at that, I think it's fairly obvious. The best trade is this short trade over here. Just because we've decided to trade the 40-day cycle doesn't mean we have to trade every single move. We don't want to trade necessarily the short trade into the 40-day cycle, then the bounce out of the 40-day cycle, then the next short trade. We don't have to take every single trade that is available to us. How do we choose which trades are going to be worth trading? What we do is we consider the underlying trend. Why? Well, because the underlying trend is the pressure of the longer cycles, and the pressure of the longer cycles and the underlying trend ends up giving us the cycle shapes that we are actually trading in the market. So let me ask you, for the 40-day cycle trough over here, let's assume the 40-day cycle trough does form in the market over here. As the market bounces out of that trough, in other words, this period of time over here, what is our underlying trend at that time for that trade? What we do is I like to plot some semicircles, because those semicircles are very useful for working out underlying trend. Here is the 40-day cycle trough that we are expecting to form. What is the underlying trend as price bounces out of that market? Well, the 80-day cycle will be turning down. The 20-week cycle will have turned down. The 40-week cycle is going up. Okay, and the 18-month cycle is also going up. So we get a +1 for the 18-month, a +1 for the 40-week, a -1 for the 20-week, and a -1 for the 80-day, gives us a grand total of 0. We have a 0 underlying trend. What do we expect when we get a 0 underlying trend? Well, we expect to get a fairly balanced cycle shape. In other words, it'll move up and then it'll move down again. Okay, but if the 20-week cycle is dominant, then we're actually probably going to see the visual evidence of that 20-week cycle, and so we're going to see a cycle which ends up going up a little bit but coming down more strongly. Okay, do we want to enter into that long trade? No, I don't. It's a long trade with a neutral underlying trend, possibly a 20-week cycle which is dominant. It's going to be coming down. What I actually want to be doing is looking for an opportunity to go short. Okay, so let's think for a moment about an opportunity to go short. How would we go short? Well, what we would do is identify, let's take a closer look at this period of time here so that we can do some drawing, and we take a look at the shape of the 40-day cycle, and here we can see a clear move up followed by a clear move down. There's a bit of an M shape in there, coming down into the 20-day cycle trough. We are expecting the 20-day cycle to cause a bit of a bounce now. Do we jump into that long trade because it's bouncing? Definitely not. We're expecting it to be a 20-day cycle trough. Of course, we could be wrong, and in a moment we're going to speak about what if that is in fact the 80-day cycle. Is it going to be worth trading? But if it's the 20-day cycle trough, then we don't want to be trading long yet. then the market is likely to turn down again, and we're going to come down into the 40-day cycle trough. Now that might be a good short trade. Remember, we've got a dominant 20-week cycle. We're assuming we have a dominant 20-week cycle, and so we have a good short trading opportunity. However, the move down into the 40-day cycle trough is likely to be really short. Remember, I want to trade for 2 or 3 weeks, I've mentioned, and this move down over here looks like it could happen really quite quickly, in less than a week. Do I want to jump into it? No. I want to make calm, collected trades, and I want to wait. So what would I do? Well, then the 40-day cycle trough is going to form over here, and we're going to get another bounce out. And then somewhere here, we're going to get the peak of the 40-day cycle, and then I get the opportunity for a really good trade, a good short trade, as price comes down into the 20-week cycle trough, which is expected towards the end of May or early June. Looking at those moves there, the move that really interests me is this one. So in terms of making trading decisions, it might surprise you that you don't look at the charts and say, what can I trade right now? Of course, if you're trading intraday, you're going to be looking to make some trades today, but you'll be looking at shorter cycles, and you don't want to jump into the trade now. You want to work out where is the best move likely to occur, and that is the trade that I'm going to be thinking about. Okay, I see a question from Martin. Imagine the 20-week cycle is dominant. We are preparing to trade short. When do we know we are wrong, and what could be the price action? Great question, and that's exactly what I'm going to move on to now. So our argument so far has been based on the fact that there's a dominant 20-week cycle, and therefore we're going to see a move down into the 20-week cycle trough. But as you know, we have analysis uncertainty surrounding exactly that issue. And we might indeed have a dominant 40-week cycle, in which case we're expecting the market to go up. We also have the possibility that the 80-day cycle trough is going to form now. So what do we do? We are making trading decisions, and as I've just pointed out, our trading decisions lie always a little bit ahead of us. If you ever find yourself making a Hurst cycles trading decision, which involves you having to decide now what to do, you must jump into the market now or forever hold your peace, then you're doing things wrong, in my opinion. Making trades on the basis of Hurst cycles is always a matter of looking ahead and knowing what to expect. So now let me touch on the other trading methodology that I use and that I work with, which is based very closely on Hurst's trading methodology. It's an extension of that trading methodology, and it involves working with the FLD and looking at the FLD. And I'm going to show you how I work with the FLD and use the FLD to determine what the nature of the market is, because at the end of the day, it's impossible for us to know with absolute certainty whether the 20-week cycle is going to prove to have been dominant or the 40-week cycle. We know there's the possibility of both of them. How can we gauge this better? How can we work it out? Well, let's go back to this chart and let's display the 20-day FLD. There is the 20-day FLD. FLDs are very, very important lines, and in our previous webinar, I pointed out that price was approaching the 18-month FLD. I'd like to bring up that FLD as well. And let's speak for a moment about what happened when price hit that 18-month FLD. 2 weeks ago, I mentioned price is heading up towards the 18-month FLD. What's going to happen? Well, one of two things can happen when price reaches an FLD. It can either cross through it and give us a nice, great cross and generates a target, or the FLD provides a level of resistance or support. And I mentioned in our previous webinar that I did expect the 18-month FLD to give us some resistance. You can see it's not perfect. It hardly ever is absolutely perfect. But price hit this FLD and struggled to go anywhere, and then finally dropped down below it, indicating that this FLD has provided resistance so far up to this point. So that's that was an interesting way of knowing that I was probably going to witness some kind of a peak forming over this period of time. Now, this 18-month cycle FLD, as you can see, drops down fairly sharply. And it's going to be interesting to see how long price tracks along the FLD. If it does come down with that FLD, then we will definitely be looking at this chart and confirming the fact that it is a 20-week dominant cycle. But let's just get rid of that FLD for now, and let's speak about the 20-day FLD, which is the FLD that I use for making trading decisions using the FLD trading strategy on an end-of-day basis. Now, when Hurst spoke about the FLD you probably know stands for future line of demarcation. It's a very simple line. It is median line, which is the median price displaced by half the cycle wavelength. So in fact, I can plot this chart as a median line chart, and there's the orange line, that's the median price, and the purple line is that same line displaced to the right by half of the wavelength. So what happens with an FLD? Well, when Hurst originally presented his material, he spoke about the FLD and presented various theoretical charts whereby you have a cycle moving like that, and the FLD, because it is displaced by half the wavelength, tends to do that. And every time you get an interaction between price and the FLD, you get a beautiful, perfect price crossing of that FLD. It's what I call a golden cross. However, in reality, that doesn't happen. In reality, what happens is you get a price cross, and then very, very often you get price coming back to the FLD and tracking along it and finding support at that FLD before it moves upwards. So I spent some time studying price and FLD interactions and came up with the FLD trading strategy. That strategy recognizes that there is a fairly reliable sequence that happens within each 80-day cycle. There are 8 interactions that we look at, and they are labeled from A through to H, and so we can see it over here. First of all, here is the A category interaction as price broke up above the 20-day FLD. Then we get the B category interaction where price comes down to the FLD, finds support, tracks along the FLD, and then it breaks up away from it. That's the C category interaction. Then the D category interaction where it's expected to cross down below it. As you can see here, it actually found support. Now that's an important point. That's called the D category interaction. Why at the D category interaction did price find support at the FLD instead of crossing down below it? The answer is because of the very strong bullish pressure of the longer cycles. Our underlying trend again comes into play. And it was clear evidence that we had a longer dominant cycle. That was our D category interaction as price came down to the FLD, and an E category interaction as price broke up above it again. Then we should have had an F category interaction where price broke down below it, which we did. Then we should have had a G category interaction where price comes up and finds support. However, here we have deviation between price and what is expected with this interaction with the FLD. What does that mean? It meant that we still had very strong bullish pressure. We then get the H category interaction as price crosses down below the FLD, which we had, and then we get the formation of the 80-day cycle trough. Okay, that's our sequence of A through to H. Then we get the next sequence starting. We get an A category interaction as price breaks up above the FLD. Then it comes down to the FLD and is expected to find support, which it did. But now let's zoom in and ask ourselves what actually did happen there. And there's a point why I'm explaining this in such detail. I'm going to make that point in a moment. Okay, assuming this was the 80-day cycle trough, here is our A category interaction. Price came up, achieved its target, had a bit of a drop back, exceeded its target, came down, found support at the level of the FLD. I think you can see that. That's the B category interaction. Now, a B category interaction is normally not a good interaction to trade. In other words, we don't go short at the B category interaction unless and here's a very important point, unless the preceding 80-day cycle trough is a subtle trough, or what Hurst called a straddled trough. You get various types of subtle troughs. They're not all straddled, but by a subtle trough, I mean that the trough has formed in the market without price coming down very strongly into that trough. So here's our trough. The move down into that trough was really very slight. That definitely qualifies as a subtle 80-day cycle trough. So what does it mean that prices dropped down fairly strongly towards the end of last week below that 20-day FLD? It means that we're seeing a shift from bullishness to bearishness in the markets. What does that mean in terms of what we're worried about at the moment, or what our trading decision is based upon? What it means is that if we're seeing a shift to bearishness, then so far we're seeing evidence that the 20-week cycle is possibly dominant. Okay, I hope you understand that. A 20-week cycle is going to give you a nice big bullish move. You should see lots of evidence of bullishness, which we did see. Okay, but then the 20-week cycle, if it's dominant, we should see a shift to bearishness. Now, if we hadn't seen a shift to bearishness, and if we had seen the price come down to that 20-day FLD and just sit on it and find support and then bounce up again, then I would have had more confidence in the fact that the 40-week cycle was dominant. But we have started to see a shift towards bearishness, which increases the odds, in my opinion, that the 20-week cycle is dominant. But you must never make your trading decisions entirely on the basis of, oh, well, I have one piece of bearish evidence, and only one piece of bearish evidence, and therefore I'm going to go bearish. Not at all. We need to watch this market carefully, and it's not going to be hard to do. Let me remind you of what we've decided so far we are going to do for our trading. We're going to watch price bounce out of this 20-day trough, then come down to the 40-day trough, which is over here, then bounce up, and then we're going to think about selling and going short. That is our trading decision. Now, it might disappoint you that that trading decision doesn't involve you entering any orders into your trading platform today. Okay? But that's the important thing about making trading decisions using Hurst cycles. You know when to expect things. And at that point, we would enter into a short trade and we would catch this move down. But every single day, or if we were trading intraday, every single 5 minutes or every 15 minutes or every hour, we are watching what price does, and we are looking for evidence that the bearishness is confirmed and was not just a momentary sort of slip below the 20-day FLD, and we're going to be strengthening our argument either way. It's a really important point that by the time we actually enter our trade, and just according to this very rough drawing that I've done, that's about the middle of May. By the time I enter into that short trade, I will have seen another 2 weeks of price action unfold. And if that price action continues to show signs of bearishness, then I will indeed enter into a short trade at that point. But now, what if the recent slip to the bear side is just a sort of a momentary quick slip? And what if, in fact, the 40-week cycle is dominant? What do we need to do in terms of making trading decisions on that basis? What if the analysis shown in this other chart is, in fact, the true analysis, and this is the 80-day cycle trough that is forming over here? What do we do? Well, what we would want to do under this situation is we would want to enter into a long trade. And let me just zoom out a little bit. We want to enter into a long trade because, and here we go, because we are expecting this to be a dominant 40-week cycle with a move up and then come down into the 40-week cycle trough over here. And so what we would want to be doing would be catching this next part of the bullish move. So how do we make trading decisions on the basis of this completely contrary option? Well, what we do is we decide at what point we would enter into this trade. assuming that the 80-day cycle trough has not yet occurred, we would want to enter into the trade as price bounces out of the 80-day cycle trough. How do we know when price has formed that 80-day cycle trough and is bouncing out of it? Well, we would use our reliable tool, the FLD, or indeed we could use VTLs if some VTLs present themselves. We don't have any VTLs yet. I'm going to show you a VTL in a moment on the other chart, which confirms that in fact a longer cycle peak is in place. So what we would do is we would watch market behavior very, very carefully, and we would wait for a bit of a bounce, and we would wait until price confirmed the formation of that trough. Okay, now when is the 80-day cycle trough confirmed? It's confirmed when the 80-day cycle FLD is crossed. So now there's an interesting subtlety. The 80-day cycle FLD is only being crossed to the downside now. Wow, why is that? Can you see that? So we can't use the 80-day cycle to confirm that the 80-day, we can't use the 80-day cycle FLD to confirm that the 80-day cycle trough has formed. So what we have to do is we have to look at our other FLDs, and we look at the shorter cycle FLDs, because we know through the principles of harmonicity and synchronicity that when the shorter FLD is crossed, that tells us that the shorter cycle has formed a trough, and because of the principle of synchronicity and harmonicity, it must also be the trough of the longer cycle that we're expecting. So we could watch the 40-day cycle FLD, or we could watch even shorter FLDs. We could watch the 20-day FLD, we could watch the 10-day FLD, perhaps even the 5-day FLD. And what we could do is we could say when price crosses up above that 5-day FLD, that gives me confirmation that a 5-day cycle trough is formed. And therefore, by the principle of harmonicity and synchronicity, that means it must be the 80-day cycle trough. But this is where your analysis uncertainty becomes very important. If we have confirmation of a 5-day cycle trough, are you confident enough in this analysis that that means that that's the 80-day cycle trough? My honest answer to that question is no. This is an analysis I don't feel very confident about. Okay, I feel much more confident about the other analysis. So in terms of entering into a long trade, I personally will be watching the 40-day FLD. And I'm going to watch what happens as price approaches that FLD. Now here's an important subtlety about working with FLDs. When price is going to make a cross up above the FLD, it will do it in a positive, confident manner, and it'll just move clearly through that FLD. When it's going to find resistance, in the case of this FLD, or perhaps support, then you can see that happening. And what you will probably want to do is you'll want to start watching some intraday charts. So you can watch how price approaches the FLD on an intraday chart and see what's happening. Here's a chart which is what's this, a 15-minute? No, this is an hourly chart, and so we can plot our 20-day FLD on this hourly chart, and we can watch what happens as price approaches it. And we can look back in the past as well and see how price has crossed very cleanly up above the FLD, how it's come down to the FLD and found support at that FLD. Okay, so you can start doing that. Luis is saying, what does the 20-week FLD show? Right, let's have a look at the 20-week FLD, and then I'm going to come back and wrap up the whole conversation in terms of what trading decisions we need to make, what trading decisions we should make. So let's quickly pop up that 20-week FLD. There's the 20-week FLD. Here's the 20-week FLD. It's still right down over here. So at the moment, the 20-week FLD isn't really telling us a whole lot. There's not a lot of information to be gleaned from it. We did see a really nice, good, clean cross over there. And in our previous webinar, I spoke about those targets and so on. I think that target wasn't quite achieved. So there might still be some upside to that in order to achieve that target. Right. So let's just summarize. We have two possibilities. We have some analysis uncertainty. We might have a 20-week dominant cycle, or we might have a 40-week dominant cycle. If we have a 20-week dominant cycle, we would expect to see price coming down into the 20-week cycle trough. So we'll see a bit of a bounce from the 20-day, then come down into the 40-day, bit of a bounce. That might give us an opportunity to go short. There's our trading opportunity for the move down into the 20-week cycle. How do we manage that? We monitor it very carefully for signs that the bearishness is there and is present in the market, and that the 20-week cycle is indeed dominant. On the other hand, if the market turns fairly bullish fairly quickly, and it looks as though we are getting a bounce out of a late, and let me just display the correct FLD, a late 80-day cycle trough, then because the 40-week cycle might be dominant, I'm going to keep my eye on the 40-day cycle FLD. Okay, so I've made two trading decisions. One is that I expect to go short about the middle of May for the move down into the 20-week cycle trough, assuming that I see consistent evidence that bearishness has come to this market. On the other hand, I'm going to be watching the 40-day FLD and be standing by to enter into a long trade if there is no bearishness in this market, if we're getting some good, strong, bullish moves coming back again. Okay. Now, if that is sort of completely, not schizophrenic, but that sort of completely divided decision about what to do really bothers you, then what is the really obvious decision to make here? We're trading the 40-day cycle. The really obvious decision to make is to postpone our decision until we have a very critical piece of evidence. What is the most critical piece of evidence that we need? We want to know what is the dominant cycle. And I don't know if it's occurred to you, I hope it's occurred to you in the course of this discussion, that we are going to know whether the dominant cycle is a 20-week cycle or a 40-week cycle. We are going to know that. And I will tell you when we will know it. We will know it when the 20-week cycle trough forms. If price comes down hard into the 20-week cycle trough, then we can look back and say, oh, we had a dominant 20-week cycle. What's going to be my best trade? Trading the 40-day cycle, I'm going to enter into a long trade as price bounces out of that 20-week cycle. Okay? If we have a dominant 40-week cycle, and let me just zoom this chart back out again. If we have a dominant 40-week cycle, then what will we see? We will see price continuing to move up and form a very subtle 20-week cycle trough, at which point it's going to come up for one more move up before it comes down into the 40-week cycle trough to form its complete shape. So again, what's going to be a good trade for me here? It's going to be the bounce out of the 20-week cycle trough. Okay, I hope this has made some sense to you in terms of making trading decisions. At any one time, when you're approaching making a trading decision on the basis of your Hurst cycles analysis, you have to identify what is the dominant cycle. You have to identify where is my analysis confidence, where is my analysis uncertainty, what things am I certain about, what things am I uncertain about. And then you need to work out what trades you're going to make. Remember, you should never be rushing after the trade that you should have potentially entered yesterday because it's too late. Okay? You need to look ahead and you need to say, when am I going to know what is happening in this market according to the cycle that I'm trading? And when I have enough clarity, that is when I am going to, with confidence, enter that trade. It always worries me when people say, oh, what do you think that the right trade is to make now? Because my trading decisions are never about what's the right trade to make now. My trading decisions are always about what's the right trade to be making in the middle of May. In the middle of May, I really think we're going to be presented with a good opportunity to go short. If the market's still looking a bit uncertain and we don't really know what's going on, or maybe we've missed our opportunity, then towards the end of May, I'm looking at a good opportunity to go long. That's the trading opportunity. I think you have to be very careful about saying what trade should I be making now? I'm going to rush home and enter my trade into my trading platform. Okay, I see a few questions. Tiddly with sentient analysis. Thank you, David. Okay, I'm not sure what that means. Brian, but it sounds good. Brian, what do your VTLs say? Right, let's speak about VTLs. VTLs are the other very useful tool that Hurst defined. They stand for valid trend lines. They are very simply trend lines which have been validated because they follow certain rules. And now this is another way that we can work out what the dominant cycle is. Thank you for reminding me, Brian. I did mean to come back to these VTLs. Here is the VTL for the 80-day cycle. Okay, and let me just point out why it's a VTL. It's a trend line which joins two consecutive troughs of the 80-day cycle. That's what makes it the 80-day cycle VTL. And so it's a straight line that joins those two consecutive troughs, and it's therefore a valid trend line. When price drops down below the VTL, as it did last week, that is confirmation that we have seen the peak of the cycle 1 degree longer than the cycle the VTL is based upon. That's quite a mouthful, but what it means is basically when the 80-day cycle VTL is crossed, we have confirmation that the 20-week cycle has formed a peak. Now that is really important, because if that 20-week cycle has formed a peak, then what does that mean? That means that we're going to be seeing generally price moving down into the 20-week cycle trough. Or it certainly means that we're not likely to see a higher peak. Okay? There's a semantic subtlety there. We might see a slightly higher peak. Yes, we might, if what they call the orthodox 20-week cycle peak is over here, but it's unlikely to be a very much higher peak. So what the crossing of that VTL tells us is that the 20-week cycle has peaked, and it's pretty much going to be downhill from here on until the 20-week cycle trough forms, which, as I've mentioned, is expected towards the end of May. It doesn't tell us whether the 20-week cycle is dominant or not, but it does tell us that the 20-week cycle peak has formed, and therefore price is expected to move down to the 20-week cycle towards the end of May, which gives me increased confidence in both of my trading decisions. My trading decision that I would go short around the middle of May, and my trading decision that I would be more interested in trading the bounce out of the 20-week cycle trough. Because if I'm not going to see higher prices between now and that 20-week cycle trough forms, then I might as well wait until then and get in at a better price and trade the bounce out of that 20-week cycle trough. Of course, you must remember that by the time you get there, you might set a reminder in your calendar, but by the time you get there, you will perform your analysis afresh. You will have new data that you can consider, and you can make a much more informed trading decision by the time we get to the sort of trading opportunity moment, as that trading opportunity approaches. I must point out, though, having mentioned this VTL and the power of it, that the VTL is very closely based upon the analysis, more closely than the FLD is. And if indeed the 80-day cycle trough did not form there, if that didn't happen, then this is not an 80-day cycle VTL. Okay, so that VTL will disappear from your chart. If I show you the other analysis, you can see that according to this analysis, There we go. That is in fact the 40-day cycle VTL, which was telling us that over here, before price crossed down below the VTL, or perhaps even over here, was the peak of the 80-day cycle. And you can see that potentially we had a slightly higher peak over there, and then we had an even higher peak over here. That's why working with VTLs is also not an exact science. You mustn't take everything the VTL says as absolute law, because you have to apply a little bit of flexibility to it and realize that the VTL is only as good as your analysis. I don't particularly like this analysis, and I'm not really particularly interested in making trading decisions on the basis of it. I much prefer this analysis over here. Now, before I sort of wrap up everything for today, I'd like to quickly show you the composite model line. The composite model line is something that I've spoken about in previous webinars. The software basically takes all of the information that we have about the analysis, and it shows us what that information tells us should have happened in the market. And assuming that the cycles continue working with the same wavelengths and amplitudes, it tells us what to expect. There's a lot to be said about the composite model line, but for now I'm going to show you what the composite model line is showing in order to help me have increased confidence in my trading decisions. If you look at this composite model line here, which is the move that you want to trade? Do you want to be trading this little move down? No, not if you're trading the 40-day cycle. This little move up? No, not really. What you want to be trading, if you're going to trade any move here, is this move here. Can you see that? That's that move. What is that move? That's the bounce out of the 20-week cycle trough. So the composite model line is also telling us to expect the best bullish move, if you like, for the bounce out of the 20-week cycle trough. Okay, that's likely to be the best move that we have available to us. Now, let me show you something else that's really interesting about this composite model line, and let me zoom all the way out. Speaking about dominant cycles, let me see if I can get this about right. Let me show that composite model line again on a really sort of big scale chart. And there it is there. The software has to do quite a lot of thinking in order to display that chart. But here is what the composite model line is showing us. Now, can you see a dominant cycle in that composite model line? I mentioned that the dominant cycle that we have had since 2009 is definitely of at least 9-year wavelength. That's the dominant cycle that we're in at the moment. Well, this composite model line, I think you can see, shows us that indeed prices come down, formed a bit of a trough. We're expecting a move up here, and then look at that strong move down over there. So what is our dominant cycle here? It's clearly that cycle, and if I measure that cycle, it comes out at about 14 years. So that's a really long cycle, indicating that quite possibly the dominant cycle at the moment is in fact an 18-year cycle. So we've enjoyed so much of the upside. We've got, according to the composite model line, we've got a little bit more upside to enjoy up until sometime early next year, after which it's going to be downhill all the way. Bear in mind that, of course, the composite model line is a useful tool, but it's not necessarily a perfect forecast. In fact, it certainly isn't a perfect forecast. Let's have a look at the... Oops, I've shown that wrong chart there. Let's have a look at the composite model line here on this chart. And here on this chart, with the 80-day cycle trough not having formed yet, the composite model line is also showing that, in fact, this bounce out of the 80-day cycle trough is not going to be very impressive. Then we'll see a move down. Can you see we're going to get really a sideways move? Does that look like a mid-channel pause to anybody? It might well turn out to be a mid-channel pause. We don't know yet. But the move that we want to be trading is clearly the move out of the 20-week cycle trough, which is expected towards the end of May over here. And let me show you one more chart here with the composite model line, a really interesting one. I showed this chart briefly last week. This is a chart that assumes that the 9-year cycle trough did occur in February of this year. So it's the 9-year cycle trough in February of this year. You'd expect it to be really, very, very positive and optimistic in terms of what's going to happen now. And if we take a look at the composite model line, you can see why I say that sometimes just because a long cycle trough is formed doesn't necessarily mean the market's going to be really, really bullish. Here you can see a very nice, pretty perfect M-shaped cycle. Okay, there's our perfect M-shaped cycle. What is the dominant cycle? Here again, it's the 18-year cycle. But what's the bad news? Well, the bad news is that we're sort of halfway through it. And so, yes, we are indeed going to see a bounce up to another peak, perhaps a slightly higher peak. That's early next year, or no, it's towards the end of next year. But then again, we're going to see this strong move downwards. Okay, I find it very, very useful to keep an eye on these longer term charts, but also let's take a look at what this composite model line tells us to expect is going to happen in the near future. Let me turn off those semicircles. Here we go. Here is, and let me just try and get that scaling about right. That's about what we've been looking at. So here is the composite model line according to this analysis. Can you see that it's showing us a downwards move, but pretty much a sideways move? And then the next good move to trade will be the bounce out of the 20-week cycle trough. Okay, so in my opinion, that bounce out of the 20-week cycle trough is really where we need to focus our analysis and our trading identification in terms of identifying our trading opportunities. Let me quickly, before I wrap up, show you a chart in MetaTrader 4. Here we go. I want to show you how these FLDs can also work really, really well intraday. I've mentioned that, of course, I've been speaking about the 40-day cycle, and I'm identifying trading opportunities in 2 weeks to 1 month away. That's my trading opportunity. I've got a month to think about it. On an intraday basis, of course, you can trade much shorter cycles, and you get the same fascinating interplay between these cycles. This is a 15-minute chart. This is the MetaTrader 4 Hurst Cycles plugin, which is being developed and is really doing very well. This orange line here is the 1-day FLD. Look at how price came up and found resistance at the 1-day FLD there, and again there. Okay, it tracked along the 1-day FLD, came down, formed a trough, clearly a trough of at least 1-day magnitude, probably 5 days. That's a 5-day cycle, circle and whiskers. It's come up to the 1-day FLD, and here you can see the generation of a target. So it's indicating that it's expecting the market to climb up to there. You can look at the FLDs of shorter and shorter charts. Here, for instance, is a chart of the also the S&P 500. This is a 5-minute chart, and you can see exactly the same sort of thing happening with these FLDs. Look at this white FLD. This is the 5-hour cycle FLD. Look at how that 5-hour cycle FLD provided support for price during that period of time over there, which was pretty much in overnight trading, I think. Okay, so I hope that's given you a really good introduction to moving from analysis into trading. The subject of trading on the basis of Hurst cycles analysis is a huge one, and I couldn't possibly cover every possible aspect of it, but I hope it's given you a really interesting insight into how you can start making trading decisions on the basis of your Hurst cycles analysis. The important points, as far as I'm concerned, are to identify the dominant cycle. What's the cycle that's really moving that market, and then choose your trading cycle and decide what is your trading cycle going to be doing over the period of time that you will be trading. Is it going to be moving up or down? Or is there analysis uncertainty and you don't know? If there's analysis uncertainty, then you need to work out when will that analysis uncertainty disappear. In this case, it's fairly clear that analysis uncertainty will be resolved towards the end of May when that 20-week cycle forms a trough. And that's when we're really going to be standing by to make trading decisions. I plan to, our next webinar is in 2 weeks' time, and that's on the 16th of May, which, of course, as you noticed, was when I pointed out that there might be a short trading opportunity. So we're going to revisit this just for a moment there and see how the markets have moved. And then again, towards the end of May, we'll take a look and see whether that 20-week cycle trough is coming in on schedule and how we can refine those the analysis of those trading opportunities. Thank you very much, everybody. Thank you for joining me. Thank you for your interest in Hurst cycles and Sentient Trader. I look forward to seeing you in our next webinar, which is in 2 weeks' time. So please make sure you join us for that. In the meantime, I wish you a profitable trading, and I look forward to seeing you there.